It's tax season, and most people are focused on one number. What do I owe, or what am I getting back? But if you're a high earner, there's a window that's open right now that closes on April 15th, and most people completely miss it. It involves a Roth account. So let me explain. High earners usually assume that Roth IRAs aren't available to them, and directly, they're right. If you earn over roughly $165,000 as an individual, or $246,000 as a married couple, you are phased out of contributing directly to a Roth IRA. But there is a workaround called the backdoor Roth IRA. And if you haven't done it yet for 2025, you still can. April 15th, 2026 is your deadline. So here's the plain English version. You contribute $7,000 to a traditional IRA, $8,000 if you're 50 or older, and then you convert it immediately to a Roth. That's it. The money grows completely tax-free. You haven't created an additional tax event, even though your income is technically too high. Now, there is one important caveat. If you have other pre-tax IRA money sitting around, there is something called the pro rata rule that can complicate this and trigger adverse tax consequences. So it's not simply a set it and forget it move. But the window is open, and it does close on April 15th, 2026. Now, there's another tax move that a lot of people miss, especially people in their 40s through 60s, and they leave real money on the table. When your tax return comes back, don't just look at the refund and file it away. Look at your marginal rate and your taxable income. The gap between what you earned and what your tax rate was and the top of your bracket, that's your Roth conversion opportunity. For example, say you're in the 24% tax bracket and you have $40,000 more dollars before hitting the 32% bracket. That means you could use that $40,000 and convert pre-tax IRA or 401k money into a Roth. Now, you will be paying taxes, but at the 24% tax rate. And this might be advantageous to you instead of paying potentially higher taxes later. And here's why this matters so much. Because most high-income earners spend decades building pre-tax retirement accounts, 401ks, traditional IRAs, and they feel really good about the balance. But here's the thing. Part of that money is going to go to the government when you take it out. And the IRS has a claim on every dollar in those accounts. So at age 73, required minimum distributions are going to kick in, whether you need the money or not. And that forces taxable income out onto your life at a time when you might not want it. And that can potentially push you into a higher bracket. It can increase your Medicare premiums, and it can make more of your Social Security taxable. So doing Roth conversions in your peak earnings as you're getting ready for those retirement years, if they're done thoughtfully and proactively, they can really diffuse the tax time bomb before it goes off. And the goal with this strategy is to pay tax now at a known rate rather than at a later unknown one. So here's the thing. When you get your 2025 tax return, ask two questions. Number one, did I do a backdoor Roth for 2025? And if not, do I still have time before April 15th? And the second question is, what does my marginal tax rate look like? And is there probably going to be a conversion opportunity for 2026? Simple questions, but asked consistently year after year, they can compound into serious tax-free wealth. I'm Taylor NISSI, and this is One Thing This Month. One idea every month to help you make smarter decisions with your money. If anything here raised a question about your situation, reach out. This is exactly the kind of planning that our team at Pleasant Street Wealth Advisors does. So we'll see you next month. Thanks for watching.